Welcome back to yet another Back to Basics accounting video, where we'll be deep diving into the accounting cycle, a very important cornerstone of bookkeeping, and all businesses, big or small, will follow the accounting cycle. The accounting cycle is a step-by-step process followed to ensure that all financial information related to a business is recorded. There might be small variations in the steps depending on the complexity of the company, but generally, these basic steps are followed by most entities. The accounting cycle begins with analyzing and recording transactions and ends with the preparation of financial statements and rolling forward into the new accounting period. But let's consider the various tasks step by step. Step number 1, transactions. Transactions are analyzed or identified from source documents. Step number 2, journals. Journals are the books of first entry and used to record the transactions. Step number 3, ledgers. Ledgers summarize all the transactions into the basic account types. And step number 4, reconciliations. Basically, you'll be looking for differences in financial accounts and correcting them. Step number 5, the unadjusted trial balance. It is a list generated from the general ledger with account names and balances. Step number 6, adjustments. Here you make adjustments to correct mistakes found in the unadjusted trial balance. Step number 7, the adjusted trial balance. Generated again from the general ledger after adjustments have been made. Step number 8, financial statements. These are drawn up from the adjusted trial balance believed to be true and correct. Step number 9, closing entries. Here, closing transfers are recorded to close the income and expense accounts. Step number 10, the post-closing trial balance. The post-closing trial balance is drawn up once the closing transfers have been done. And step number 11, reversing entries. Reversing entries are made at the beginning of the next accounting period. It is important to note that steps 1 and 2 will be performed daily. Steps 3 to 5, so from ledgers to unadjusted trial balance, is performed monthly. And then step 6 to 11 is done at the end of the accounting period. I would like to take a deeper look into each of these steps and explain a bit more. Some of these steps are somewhat more involved or complex to discuss in this video, so you will find separate videos for those on this channel. But let us consider a bit more detail about each step. Starting with the first step, transactions. A transaction is an event that has an impact on the financial statements of a business. There are basically 3 categories of transactions, namely cash transactions. This is a transaction where cash is received or paid. For example, packaging is bought with cash. Credit transactions, where goods or services are sold on credit to a customer. And then there's other transactions. This will be transactions that do not involve cash or credit. For example, provisions, accruals, or depreciation entries. We can't talk about transactions without mentioning source documents. Source documents are the original records or documents containing the key details of a transaction, including its date, the purpose of the transaction, the amount, the supplier details, the customer details, etc. It is extremely important that both the buyer and the seller keeps their source documents, as this is the proof that a transaction took place. The source documents include, but are not limited to, invoices, receipts, credit notes, checks, deposit slips, pay slips, etc. Your source document is your first document used to identify and record a transaction. Moving on to the second step, journals. Journals are the books of first entry and are used to record the transactions in a standardized way. And remember, this is done daily. So at the end of the month, the journals are posted to the general ledger to show how the transactions affected the accounts. There are various types of journals, and each type of journal is used to record a different type of transaction. The different journal types are cash receipt journals and cash payment journals. These journals contain all transactions that basically affect your bank account. You also get petty cash journals, and these are transactions that have been done in petty cash. Then there's debtors journals, which contain transactions with your debtors. In other words, sales made to customers on credit. Then you have your creditors journals, and this again is purchases made from your suppliers. Then you get your debtors allowance journal, or also known as the sales return journal. Here you'll record any returns that came back from your customers for credit, or any discount allowed towards your customer for payments made on time. You also get your creditors allowance journal, known as your purchase return journal. So here you record transactions for goods that you return to your supplier for a refund, or where you have received discount from your supplier for a payment made. Then there are salary and wages journals, and I think here the name is self-explanatory, where you record transactions that relate to salaries and wages. And then lastly, there's the general journals, and these are transactions that do not fit into any other journal. Each of these journal types will be explained in a separate video with practical examples, which you'll be able to find right here on this Back to Basics channel. Step 3, ledgers. The general ledger summarizes all transactions into the basic account types, namely assets, liabilities, owner's equity, income, and expenses, to show the financial activities of the business. The information is posted from the various journals to the general ledger at the end of each month. The debtors ledger and creditors ledger, referred to as subsidiary ledgers, record additional details about the debtors control and the creditors control accounts in the general ledger. Step 4, reconciliations. So at the end of each month, the bookkeeper performs certain reconciliations to ensure that the balances reflected in the general ledger agree to the subsidiary ledgers, source documents, and journals. The 3 types of reconciliations performed at month end are debtors reconciliations, creditor reconciliations, and bank reconciliations. To perform a debtors reconciliation, you need to agree the total of the debtors list, which is generated from the debtors ledger and shows the individual balances owed by each customer, to the debtors control account in the general ledger. The differences between these 2 balances must be investigated and then corrected. Similarly, when performing a creditors reconciliation, you need to agree the total of the creditors list, which is generated from the creditors ledger and shows the individual balances owed to each supplier, to the total of the creditors control account in the general ledger. And any differences between these 2 totals must also be investigated and corrected. Another creditor reconciliation to perform is taking the individual creditor account balances from the creditor's ledger and comparing it to the creditor's statements, which is received directly from the supplier. And again, if there is a difference between the two balances, it must be investigated and corrected. The bank reconciliation is a very important month-end reconciliation. In order to perform your bank reconciliation, you need to take the previous month's bank balance, plus your total cash receipts for this month, less total cash payments for the month, and that should equal your bank statement balance, except for uncleared items. So if there is a difference between your calculated balance and your bank statement balance, this should equal your uncleared items. If it doesn't, then that means a mistake was made, either in the cash receipts journal or in the cash payments journal, and it needs to be investigated and corrected. Remember that the cash receipts journals, the cash payment journals, and the bank reconciliation statement is all maintained and generated by the bookkeeper. Your bank statement is received directly from the bank. Step 5. Generating the unadjusted trial balance. A trial balance is a list of all the accounts in the general ledger showing their balances at the end of a period. It is drawn up or generated in a specific format containing at least the following: the account number, the account name, a column for the debit amounts, and a column for the credit amounts. The purpose of the unadjusted trial balance is to show an overview of the accounts and their balances, and to check whether the total debits equal the total credits. If any errors are found during your review of the unadjusted trial balance, it must be adjusted and corrected. Step 6. Adjustments. So from the unadjusted trial balance, we need to adjust for any errors or omissions found. Some accounts also need to be updated before the end of the accounting period, and these updates might include things such as depreciation, provision for bad debt, accrued income, prepaid expenses, etc. These corrections and updates are called adjusting entries and are made in the general journal. The types of mistakes that could occur include an entry that has been made in the incorrect account, an incorrect amount that has been recorded, or an omission of an entry or a duplication. To correct a mistake, you first need to identify the incorrect entry, then determine the correct entry. You then compare the two and adjust for the difference. Or you can completely reverse the incorrect entry and then record the correct entry. The next step, step 7, is then to draw up an adjusted trial balance from the general ledger after the adjusting entries. And again, you will check that total debits balance to total credits and that you are satisfied that all errors have been corrected. Step 8. Financial statements. Financial statements are prepared at the end of the accounting period using the adjusted trial balance. Financial statements consist of the statement of financial position, the statement of comprehensive income, the statement of changes in equity, the cash flow statement, and the notes to the annual financial statements. Financial statements are analyzed to better understand the financial position of the business and how well the business performed during the accounting period. Step 9. Closing entries. To prepare the general ledger for the next accounting period, you need to close off your income and expense accounts, also called nominal or temporary accounts. This is done by processing journal entries that are called closing entries in a general journal. The income and expense accounts are closed off. In other words, transferred to the retained earnings account in the case of a company, or to the owner's capital account in the case of a sole proprietorship. After all the closing entries have been processed, all income and expense accounts will have a zero balance at the beginning of the next accounting period. Step 10. Generating the post-closing trial balance. The post-closing trial balance is drawn up once the closing transfers have been done. The purpose is to check once again whether the total debits equal total credits. This trial balance will only contain assets, liabilities, and owner's equity accounts. Step 11. Reversing entries. Reversing entries are reversals that are made at the beginning of the next accounting period. These entries are recorded in the general journal and are used to cancel out an adjusting entry that was recorded in the previous period. Reversing entries are to avoid a transaction being recorded in both the current and the previous financial year. For example, accrued expenses, accrued income, prepaid expenses, etc. And that's it. You have now completed the full accounting cycle. And then it starts all over again. So there you have it, short and simple. Subscribe for more Back to Basic videos, and feel free to like and share these with anyone who might benefit from it. And if you have any questions or you would like to see a video on a specific topic not yet uploaded, just drop me a comment below. Also, if you would like printable clips of this video, where you can make your own notes or something like that, just ask. I don't mind sharing.